But let's talk about Kestrel, because that was the first deal. It was a big deal. It's generated a lot of revenue for you, but it has that aura of, it's dirty old coal. I think people would think of it, but it's not that really, in the sense of conventional coal, is it?
No, it's the coal that's used for steel making, and
Right.
it's not nearly as dirty as the other coal.
Right.
And the other thing about Kestrel is it's producing enormous amounts of income for us. But after a couple of years, and that's now probably 3 years away, it starts to decline. So our overall coal exposure is really going to diminish quite rapidly over the next couple of years. But Kestrel is really important in terms of being able to make the steel that the world needs for development. And I think there's increasingly a distinction amongst investors between the coal that's used for energy, which we also have a very small amount of. We do have some exposure to that. It's around 7% of our income last year. And the other type of coal, which is used for steel, which is much more difficult to substitute and not really part of the energy complex.
Right, it's worth distinguishing, because most people just see the word coal and they don't understand. So when you're talking about this green story, this green focus, the part of the EV revolution, it's, people need to understand that you truly are delivering on that, or trying to deliver on that. Have they been making life difficult on you? I know they're going to tail off, but have they been making life difficult in the sense that they're generating more revenue for you right now as a percentage of your total portfolio?
Well, I don't think that's a bad thing. I mean, having more money is always good, and it's something we can recycle into other materials and commodities, which is what we're in the process of doing. But I think the fact that they are really ramping up and growing so rapidly is a good thing, and it also gives us really exposure to coal in the quite short term. So if there are more material negative consequences for coal in the medium term, we'll be pretty much inoculated against that.
Right, and are you happy, because again we talked about the American precious metal type royalties. These are billion-dollar companies, $2 to $12 billion companies. They have size on their side, and gold's obviously doing very, very well at the moment. So there's nothing short of good for them. Where are you happy to sit and position yourself? Do you want to compete with them, or do you want to find your own niche being this greener royalties and streaming company?
Well, I think we want to find our own niche, but obviously we would like to be of a similar size in terms of market cap. And what's interesting is the most successful of those companies, which is Franco-Nevada, trades at something like a 90 times PE ratio, and we trade at a 9 times PE ratio, or maybe even 7 or 8.
Right.
So there's a tremendous valuation gap, and how we bridge that valuation gap, I think, is one of the challenges we face in terms of getting better known.
Right.
But we certainly don't want to compete with them because of their very elevated ratings. They have an extremely low cost of capital. The market seems to still back them, but I think for the risks associated with the mining sector, getting 8 to 12% or more on your investment and your financing makes more sense, and that's really what we can achieve if we don't compete in the gold and silver space, which is highly competitive. And what's very interesting about the mining sector recently and the way in which it's evolving is this increasing lack of capital coming into the sector, and the fact that the cost of capital continues to go up. And I think, as you say, a pretty unique investor to the non-gold and silver sector, we see so much deal flow, and we see much better terms now on the table, both in terms of return, but also in terms of the details of the contracts we can negotiate with our counterparties.
Right, okay. Understood. Can we just talk about, you said before when we spoke before, this is mining without the mining risk. That was a nice opener to what royalties are in the mining space. And if I look at your portfolio now and what you said to me about this, being part of the EV revolution, how are you going to be able to scale up? Because again, I looked at the presentation, you looked at 222 deals, you did 2. It's hard. It's time consuming. It's expensive.
Well, no, it's hard to make money. You can put money out and people will take it 24/7.
Right.
So we could have done many more deals, but I think The trick has been to invest wisely and make sure that we're getting in at the right stage of the cycle, investing cheaply and have a good entry point. But there is, a lot of opportunity, and as I said, because of the shortage of capital in the sector, I hope that we will be doing more deals, 3 to 4 a year. But we will never be a deal machine if we want to do good transactions.
Right.
Particularly as most of our focus is on producing royalties and not on the development of royalties, which is the area where there's a lot of risk, but also capital shortages.
Absolutely. And so, again, coming back to the scale thing, how do you drive scale? You've set yourself some thresholds. So what are the criteria by which you will and won't invest? Because you want, clearly, the returns is the ultimate number.
Well, returns is one of the numbers.
Right. What's the most important thing for you?
Well, there are many. One is not being in bad jurisdictions. One is being part of this coherent story about having purer, less polluting materials, the counterparties behaving responsibly from an ESG perspective. Part of it is being, low cost. Part of it is being with honest counterparties. So many criteria, which is the explanation for why we only did 2 deals last year, because it's very difficult to tick all those boxes. But this year we, are confident that within the first quarter we will announce two transactions, and so I think we're on course to put more money to work in more deals. We, in fact, just announced, as you may be aware, an extension of our borrowing facility, so we have more firepower. So I think we are very conscious of the need to accelerate the pace of investing, and there's some things that came over from the end of last year which will be completed in the first quarter of this year.
Right. So I guess what I'm trying to establish is you have some standards and some controls in place which you're not deviating from, because you want to hit certain numbers. I get the soft stuff. That sets you apart. You're saying this defines us, it differentiates us. I get that.
Yes.
But you've also you want to hit good numbers, returns to the portfolio,
and there,
revenues.
We have a roughly 6% dividend yield today. We can borrow money at 3%, and our criteria are to get sort of after-tax returns of 8 to 12% for the very best quality royalties, going up to 15 to 20% for situations which have more development risk.
Right.
And ultimately, that is an overriding criterion. So we need to make sure that the deals we do are accretive to our shareholders, and we keep growing as we have done over the past couple of years. But increasingly, there are these other issues which are very important and relevant to us. So even if we had, a 20% deal in a terrible jurisdiction which was very polluting, we wouldn't do it,
right?
Because we are on this path to be, part of the story of how we green the planet.